This is Grussell PLC, question 14. It's a cash flow question that came from the 7127 paper for June 22. Two statements of financial position. Make sure you get the years around the right way. 2022 and 2021, and they're set out in the kind of alternative layout, international accounting standards, where you've got assets at the top and then equity and liabilities at the bottom. Some additional information about tax for the year was 6534. That will be the income statement figure. So that will be what was deducted from the income statement, not the same as the tax paid. You've got dividends paid during the year with 24,000. A second debenture was taken out on the 1st of November 2021. So our year ends in March 2022. So that debenture was outstanding for November, December, January, February, and March. So 5/12. If we look at the original amount of the debenture, 70,000 was owing at the start, and it's gone up to 90,000. Okay, so that amount was outstanding for 7/12 of the year. That amount was outstanding for 5/12 of the year. It's a 6% debenture, so that means that every year we need to pay interest of 6%, and it's going to have to be time apportioned in this case because of the increase in the amount of the loan. A non-current asset which originally cost 62,000 with a net book value of 35, so that means that the depreciation is the difference between the two. 62 minus 35, 27,000 to date, was sold for 39,500. So that means they've made a profit on disposal of 4,500. And what we're asked to do is prepare a reconciliation of operating profit to net cash flow from operating activities for the year ended 31st of March 2022 to comply with IAS 7. So for those of you that are familiar with my mnemonic, this is the penguins and drunk dinosaurs bit. So what I would suggest we do at this point is actually write out the layout. So profit from operations. Okay, then we make adjustments for depreciation and disposals. So that's the penguins and drunk dinosaurs. They're in Rome, which is to do with inventories and trade receivables. And they're posing, which is your payables. Cutely, which is cash from operations. And then they are in the nude, which is interest paid, tax actually paid, not the same as that figure up there, the 6534, and then net cash from operating activities is your last line. Okay, so we need a pound sign at the top. I'll have to put that above the, I haven't left myself enough room there, got a bit carried away. Now the first figure we're looking for is profit from operations. Nowhere here has it told us the profit from operations, so we're actually going to need to work that figure out. Now profit from operations, so let's make that working one. So profit from operations. Now the starting point when we're not given profit from operations has to be the increase or decrease in retained earnings. So at the start of the year we had, let's have a look, retained earnings were 111,597, and they've gone up to 122,030. So let's start with the increase in retained earnings. So they've ended up at 122,030, but they started the year at 111,597. So the difference between those two amounts, 122,030 minus 111,597, is 10,400. Can't see that. £10,433. So that's how much retained earnings have gone up. Now, if you remember, retained earnings is arrived at from the profit for the year, which is the profit after we've paid interest and tax. So operating profit comes before interest and tax. And the difference between the profit on the income statement and the profit that lands up here is that we've paid out dividends as well. So the way to do this, I always think, is to work backwards. So think about the statement of changes in equity. Obviously, you've got the retained earnings there, but that will include dividends paid. Okay, so we'll need to find out that figure. Then we're back onto the bottom of the income statement. So the penultimate figure on there is going to be the tax provision. So this is the income statement figure, not the paid amount. So the tax paid goes in the cash flow statement, but the figure on the income statement probably won't be paid until next year. And we also have to add on any interest paid, and that's going to be what would be labelled as finance costs. Okay, so let's see how much of this information we've got. Let's see if we can find out the dividend. Well, yes, additional information number 2 there tells us that dividends paid were £24,000. It also tells us up here that the tax for the year, so this income statement figure, was 6534, and the interest paid we're going to need to work out. So the interest paid, remember we had two amounts there. We had 70,000 that was outstanding for the first 7 months of the year. So 70,000 times 6% times 7/12. Into my calculator. 70,000 times 6% times 7/12 is 2,450. And then the loan went up to 90,000 for the last 5 months of the year. So 90,000 times 6% times 5/12. 6% times 5/12, 2,250. So the total interest paid, 50, is actually 4,700. So if we add all of that together, that will give us the operating profit. Profit from operations. Okay, so we've got 10,433, 24,000, 6,534, 4,700. So that's going to go in on our top line, 45,667. So let's label our cash flow here so that any examiner can find the workings that helped us arrive at that figure. So 45,667 is the profit from operations. So that's possibly the hardest bit. If you get in a pickle with this, just do your best. Try not to leave it blank, but if all else fails, just carry on with the rest of it, because there will be lots of marks available for workings and for some of the figures as you go along. So remember that cash from operations is a subtotal, and net cash from operating activities is the final figure we're looking for. So if we look at the depreciation, let's actually look at what's happened in terms of depreciation. So we started the year with 339,930. So the depreciation has actually increased. The depreciation provision has gone up by a total of 68,555. Now, if you just stuck that answer in there, you'd have got one of the marks out of the 2 or 3. I think there were 2 available. Yeah, 2 available for depreciation. But what we have to remember is that this asset has been got rid of, and the depreciation on that asset was £27,000. So we need to add that back on. So £27,000 is the depreciation on the disposal. And if you think about it, what we'd be doing here is starting with the brought forward depreciation, minusing 27,000 from that, and then comparing the result with that. And the difference actually is going to be 95,555. Okay, so we're going to pop that in, 95,555. So we add depreciation, because depreciation has reduced the profit, but it doesn't have an impact on cash. Okay, with the disposals, be careful here, because it's a profit on disposal. So that profit of 4,500 we worked out up there would have increased profit, but remember, it doesn't have an impact on cash, not the profit anyway. The sale proceeds of 39,500 would be an inflow in the investing activities, which we're not required to do. So all we've got to do then is deduct the 4,500 in profit. Okay, inventories, receivables and payables, very straightforward. So the inventories have gone down by, let's have a look, 36,345. They've gone down by 2,222. That's good for cash. If we've reduced inventory, then that means we're not holding on to surplus inventory. We're not tying up cash. So we can add that one back. Trade receivables, though, have gone up. Now, remember, that's bad for cash. Let's find the difference. 27,234 minus 25,346. That's gone up by 1,888. So we're going to deduct that in the cash flow, because we are not collecting that money from our customers. Therefore, it's bad for our cash flow. Okay, trade payables. Let's have a look and see what's happened. They're down the bottom here in the current liabilities. So they started at 17,486 and they've gone down to 14,064. So we've paid an extra 3,422. We need to deduct that because reducing the payables. Whilst it's good for the relationship with the suppliers, it's bad for our cash flow. So let's find out what the subtotal is then. 95,555 minus 4,500, 2, minus 1,888, and minus 3,422. So the cash from operations we're looking for there is 133,634. Then we've just got to take off the interest paid. Now we already worked that out. We don't need to do that again. Oops, it's over here. The interest paid was a total of 4,700. So we can deduct that. It's an outflow. We added it here because we were trying to get back up from the increase in retained earnings to the operating profit. But in the cash flow, we deduct it because it's a payment. Now the tax paid, I'm going to suggest we do another working here for the tax paid. So working number 2, tax paid. What we need to do is start with the tax that we owed at the beginning of the year. So let's find the tax liability. It's down in current liabilities. So the tax payable, the brought forward figure, was 1,800. Plus we've got the figure from the income statement. So the provision, the charge for the year, that's 6,534, which was given to us in the additional information there. We're going to add that on. Then we're going to take off the carried forward figure. So that's the tax that's still owing at the end of the year, 2,500. And then the difference is going to be the tax that we've paid. So 1,800 was owing at the start of the year. We've added another 6,534 to the liability for this year's charge. We still owe 2,500 at the end of the year. So that means we've actually paid 5,834. So that needs to be entered as an outflow on your statement of cash flows. So we can now just complete the final stages of this. 5, 8, 3, 4. So that means that the net cash from operating activities is 123,100. Easy as that.